Hello and welcome to Deep Macro's Future of Finance podcast. My guest today is Ruth Colp-Haber, who is the founder and CEO of Wharton Property Advisors. It's a real estate consultancy that represents tenants leasing office space in New York. So why are we talking about real estate today? Well, the basic reason is I've always been surprised why economists don't pay more attention to real estate, because real estate is always the cause of basically all blowups that we see in the market. And also, for its part, the economy affects real estate, unless you think that things like rental income and interest rates don't matter to real estate. So we have a lot of synergies here to talk about. And I think that Ruth is one of the best people to talk about, especially with respect to New York real estate. She started Wharton Property Advisors 25 years ago, and she was in the real estate business before that as a mortgage trader. She has been a member of the Real Estate Board of New York since 1989. She's very widely quoted in the media, and we're lucky to have her here today. Thanks, Ruth.
Thank you.
So tell me first just a little bit about Wharton Property Advisors and what do you do?
Okay, well, first of all, thank you for the opportunity, Jeff, and I hope
I should mention that we used to be office mates, next door office mates at WeWork.
Yeah. Yeah, just a little bit about my own personal background. So I'm a fourth generation native New Yorker. I'm actually the first person in my family to go into business. My parents were both physicians. Both my grandfathers were physicians, and my husband's an attorney. So I come to the real estate business with a little bit of a different approach. I have an MBA in finance, and then I was a mortgage trader on Wall Street, as you said. So I see many aspects of the real estate market. And I saw an opportunity in this market for representing tenants with honesty and intelligence and creativity. And it's worked well for me. We definitely punch above our size, so to speak, and do a lot of deals and many repeat clients. We work mostly with hedge funds, broker-dealers, nonprofits, law firms, accounting firms, all types of users of office space.
Okay.
So we see the whole spectrum of what's going on in the city, which of course is extremely interesting,
Okay.
especially now.
Okay. I mean, you really have been in the media a lot recently. I've seen articles or interviews in the Wall Street Journal, the Financial Times, Bloomberg. I think you did a segment on the BBC recently. I mean, for the BBC to be so concerned about New York real estate seems a little bit strange. I mean, what's the interest level by the media, and what do you talk about that actually doesn't get into the shows?
Yeah, well, remember, the story of what's going on in the office is not just about the office. The fact is that the major office buildings that comprise the central business districts of New York and all the other cities nationally and internationally, these buildings are at the crux of the city's economy. And what's going on with the buildings affects the banks. It affects the owners of the buildings, which are insurance companies, pension funds, states. And then, of course, many of them are in the CMBS structure now. So those have a widely distributed ownership structure. So there are big repercussions in terms of what's going on. And we have a change in our industry now that we've never seen anything like this.
Okay. So how would you then just overall characterize the New York City commercial real estate market?
So there has been a change in the nature of work that we haven't seen since the industrial age in the 1800s. It used to be that people would go to an office building in order to do their work. That is where commerce took place. That's not the case now. Now, probably half the work being done is being done from people's homes. And those people are really happy working in their homes. And that's a big problem. It's great. It's great for quality of life. It's great for caregivers. It's great for parents and children of elderly parents.
But it's not great for.
It's not great for the cities.
Right.
And even more for the owners of the buildings that have had a certain amount of demand for their product, and their product is office space, and the demand curve has now significantly shifted downward, probably 30% for their product.
Wow. And would you say this is all because of the pandemic, or was that an accelerant of trends that were already happening? We see that in a lot of different areas of the economy.
I'd say the pandemic was the accelerator, but when you think about, as you said, all the areas of the economy that have changed as a result of the pandemic, they've all kind of gone back. I mean, the hotels were hit, air travel was hit, schools were hit, but all that's back to normal with one major exception, and that's office space, where we're at about 60% of people going into the office now. It used to be 90%.
Right. And the 60%, I mean, we kind of, as far as I can recollect, New York kind of reached that level, I don't know exactly when, but let's just say 2 years ago, sometime in 2022.
Yeah.
Has it changed since then? It's just been kind of stable, because you still see companies announcing, you got to get back in the office, and it does work, it doesn't work. It seems like is that the cap, 60%?
No one knows what's going to happen. We have been at 60% for the last 2 years, as you said. And there's really sort of a warfare, might be too strong a word, but there's a lot of conflict in workplaces because the CEOs want their employees in the office. I mean, the CEOs are sick of this. I mean, you try to get an employee on the phone, they're cooking their lunch, they're at the gym, they're walking their dog.
Sounds
for the
like me.
CEO. Right. The CEOs don't like this. They're trying to get their employees back. The employees don't want to come back for the most part.
Okay. So it is a structural shift. We may go higher, but we might not. There are real costs to the owners of the buildings and others. A lot of people have been wondering, well, what can we do then? Assuming that this is, we're not going to go back to 90%. One of the potential solutions has been converting some of these spaces to residential, because we know that New York probably has a shortage of residential property. Is that a realistic solution? And can you give me some examples and some numbers?
Yeah. So I would say it's the residential conversion option is a great option when it works for a building. The problem is it only works in about 5% of the cases. A lot of building owners are looking at that option, but the problem is the financing is still very high due to the higher interest rates, and the construction costs have gone up 50% in the last 3 years. And these are massive jobs because office space has very different layouts than residential space. And you need a lot more windows and working windows. As you notice, in most offices, the windows don't open.
Right.
So that alone, replacing all the windows, is a huge job.
And that has to be done too.
It must be. And this is by zoning law, by New York City zoning law, and really in all the other cities as well.
So it's expensive. I think you're also saying that there are regulatory issues with zoning. And there's also physical constraints.
Yeah.
Have there been any done in New York City? Are there any examples that are either done or almost done, or?
Definitely. Where we're seeing the most conversion options that work in New York now are the financial district, which is kind of interesting considering, that's always been a commercial hub, but the residential conversions there have really been happening for the last 20 years, but they have accelerated. And what you have in these buildings, first of all, you've got a lot of buildings right near the water, so they've got great views. So these make potentially really interesting condos or high-end rental units. And these are buildings that, from a commercial leasing standpoint, are considered functionally obsolescent. Meaning they really would need a lot of upgrades, even for their regular commercial use. So something has to be done. So all the money is going into the residential conversion, where they sell, these apartments will sell or rent a lot more quickly than as a commercial property.
I see, okay. I mean, and I know that you have a lot of relationships with the government. I mean, obviously, you know, you kind of alluded to it. If people are not in the office, then it hurts the commercial, like the just retail, restaurants, what have you. It obviously hurts the tax, it will certainly hurt the tax base. I mean, is the New York City government working on making these conversions easier, or is it just limited stuff that they can do given the nature of the problem? There will be a certain number that are good candidates, but a lot just not going to happen.
The government is definitely working on making it easier, because there's also a serious housing shortage in New York City for affordable housing. And unfortunately, most of these projects that are being converted, they're not going to affordable housing. They're going to high-end rental or condos, which isn't helping the affordable housing dilemma that we're in. But the government is working on easing up the zoning restrictions to enable more conversions. And then it's also kind of interesting, what we're seeing the government do is demand workers come into the office, government employees.
The city employees, right?
The city employees to come into the office more. Again, the employees are fighting it from what I hear, but that would help too. I mean, the more people coming into the office, the better it will be for the commercial buildings.
Sure, okay. So let me shift a little bit more toward the financial side. I think it was about 2 weeks ago, the AAA tranche of a commercial mortgage-backed security backed by a New York City property, I believe it's 1740 Broadway, suffered a loss. The lower tranches, I believe, were wiped out, and the AAA tranche lost 25% or something. And I think that that was the first loss on a AAA CMBS since the global financial crisis. Is that going to have a knock-on effect? Give us some color, because I think that a lot of people who are not real specialists in these markets have a hard time conceptualizing that.
Yeah, so it's very interesting what's been going on in the market in the last couple of months. So we're going kind of from one crisis into another crisis. So our initial crisis was the impact of hybrid work and the drop in vacancy rates. Now we are in phase 2, which is a financial crisis. And the crisis is that if you are a New York City office owner and you have a mortgage coming due, your banker is not returning your call. No banker is returning your call. Okay, with the exception, there may be 10 buildings in New York where they can get financing. The vast majority, the banks have just shut down office lending.
Wow.
Not only that, you have to keep in mind a few other things. Number one, this is a very highly levered industry.
Right.
Okay, so this affects the majority of the buildings out there. Then the other big problem is most of these buildings took on a lot of debt cheap. I mean, so these building owners have loans at 3% coming due now.
Right.
So if they were a AAA credit, maybe they would get a 7%. Now it's like 15% in the private credit markets.
Ouch.
Yeah. And then not only does the rate go up a lot, but they have to put in a lot more money. They have to put up guarantees. They don't get the same loan to value. The entire scenario has totally changed. And this is why, you know, I'm happy to be talking to you, because we need some deep thinkers looking at this issue. And your idea regarding tokenization, I mean, this is what the industry, I mean, we need fresh ideas, because the model for financing these buildings and owning these buildings doesn't work. And we're just at the beginning of this crisis, by the way.
Right. Well, let's move to that, the tokenization, because I think, you know, we chatted a little bit before, and certainly Deep Macro has been looking at these issues that, you know, it seems like whenever we go through one of these kind of crises, and the banks, assets are stuck on the bank's balance sheet, or even like you mentioned, the CMBS market's very diverse, but they get stuck. We need to get properties moving, and tokenization is potentially a way to do this. You can chop the ownership rights into smaller fractions. You can trade them in a more liquid manner. If you don't like something, you can get out, get into a different sector, get into a different city. Do you have any thoughts on, is this one of the tools that should be in the toolkit, kind of like the MBS market started, in the 60s and 70s?
Yeah, look, I think it's a great time to be seriously considering. There's no uniformity to the office buildings, but there's no uniformity in the CMBS market either. And they pool together all different kinds of buildings. But the owners are pretty desperate for new mechanisms to help them retain ownership or switch ownership, bring in partners, bring in equity, bring in debt. So they have to look beyond their traditional local community banks to any alternatives that could work. And of course, you need some visibility, and these are perhaps complex systems that need to be explained, but to me, the opportunity is huge.
Exactly. I mean, it's just a matter of matching owners with buyers, and new sources of buyers, as you mentioned. I mean, banks might not want to lend, but there is still a lot of liquidity out there in family offices, in high net worth, and in places like that, that if anything have excess cash. So it really is a matter of getting the mechanism to get the cash from the people who have it to the people who need it. And I agree that, hopefully this is something that we'll do some deep thinking on that.
Well, we need deep thinking, Jeff.
Great.
So you should definitely get to work on that.
Yeah, well then, obviously we have this crisis. I totally agree. But on the other hand, people love to talk about green shoots. And I did see a funny headline from the Wall Street Journal this week. I think I'm going to quote it. Green shoots, quote, "Green shoots grow out of control on Wall Street. Bankers' favorite metaphor is sprouting all over as optimists see signs that deal making is coming back to life."
Yeah.
End quote. I mean, what do you think about the green shoots theory? Do you see people beginning to bite, or is it just?
I wish that would apply to real estate, that quote, but right now I don't see it.
Okay.
The real estate moves in very long cycles compared to stocks and bonds.
Right.
We move in 10-year cycles, and I'd say we're 4 years into this now. So we have a ways to go.
Okay. All right, that's interesting. Then, look, is there anything else? I mean, New York City is the best city in the world, right? That's I mean, you're for
that's my belief.
Not that I could have told from your accent or anything, but I assume that you're still an optimist, that these issues will be worked through.
Yeah. Look, we're masters at reinventing ourselves. We attract the brightest people, the most ambitious people. We have the biggest rats in the biggest race. I mean, we are the largest office market in the world and the most dynamic city that ever existed. So we'll figure our way out of this. But we do need some creative thinking and looking at the problem, taking several steps back and looking at it fresh. And what are we going to do with our central business districts and these office buildings? I mean, this is a huge stock of real estate. And some of these office buildings are going to become dirt, by the way, and are going to trade as dirt and then probably be rebuilt in residential, in residential structures. But we have to get there.
Okay, great. Well, Ruth, thanks so much for having joined us today. Thanks so very much.
Okay.
The content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this material constitutes a solicitation, recommendation, endorsement, or offer by Deep Macro Incorporated or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction. All content is information of a general nature and does not address the circumstances of any particular individual or entity. None of the information constitutes professional and/or financial advice, nor does any of the information constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. There are risks associated with investing, loss of principal multiple is possible. Some high-risk investments may use leverage, which will accentuate gains and losses of securities or firms' past investment performance is not a guarantee or predictor of future investment performance.